Hi guys, I'm going to talk about Tesla today and its value and how far it's gotten ahead. I'm going to tick everybody off who loves this stock and tell you that it is a bubble, it's a disaster waiting to happen. Now look at the long-term chart here. Uh, this is a monthly chart. Bazam, it looks like a hockey stick. Now, to discuss this is more than looking at the chart because we could compare it to other stocks. It's done phenomenal. It's laughed off the drop in March, and the company. Make no mistake about it. This company is great. It's doing amazing things. It's firing on all cylinders. With pardon the pun, um, it's doing great with cars. Its potential for trucks when they finally start rolling off the assembly line is going to be awesome. Energy storage, energy production, energy management, I think will far outpace their automotive sector. Um, I think their insurance initiative is a great idea. Long term, this company is going to do amazing. However, people are confusing the company with their stock. And all stocks eventually settle into a valuation range. People are willing to pay a certain amount for earnings in the future. And based on their growth or foreseen growth. Um, so let's compare some other stocks. They're in the S&P 500. We're going to look at the top by market cap. Tesla which is number 5, biggest company in the world by market cap on the S&P 500. And let's compare it to, for instance, Apple and Google. Um, I'm not going to show you the PE ratio chart right now of Tesla because it's not measurable. They just started earning, and it's a flat line with a big jump in the last year. Now let's look at Apple. I think Apple's price is potentially really overvalued in terms of, for the last 10 years, people have been willing to pay, 18%, 18 times their earnings. And all of a sudden they're at 39 times earnings. That's an awful lot and uncharacteristic. If you compare it to something like this is the price growth, this is the stock price. Let's compare that to Google, who's had a very smooth growth trend and awesome stock. Their PE ratio has been relatively stable over the last 12 years, 13 years that we have here. And right now, their PE ratio is quite reasonable, even compared to their own measures. Like, people have paid much higher for the stock before at these periods in 2007 and 2018. Now, so right now, Google is not overpriced by any measure, and Google, they're like a VC. They keep buying new firms. They see stuff that's up and coming. They buy it. They're growing their earnings that way by internal and external, like by purchase. So that's a quick discussion of PE and relative PEs. Let's look at the top 10 of the S&P 500 by capitalization. And I put Tesla at the top just to show, but they're number 5. The rest of them are in order. Apple being number 1 right now, largest cap company in the world. Their PE ratio is 39 times earnings, which is pretty high. Amazon, arguably the fastest, growing stock outside of Tesla in the S&P 500, is priced with that kind of PE ratio at 91 times PE, which, as you can see, is almost triple the closest one. Well, just over double Apple, but triple anything else, reflecting its growth. Like, if this was, a utility stock is around 20, maybe 30% if they see massive growth for utilities, but because there won't be huge growth with a utility stock most of the time. So P ratios reflect that. This is a growth PE ratio of 91 times for a large stock. Okay. Um, Nobody's saying Amazon's mature yet. They're firing up in businesses all over the place. They're finding ways to earn money. They're just getting started, really. And their earnings are getting up there, right? Per share, their earnings are $34 a share. But let's compare Amazon, which to me is quite an overvalued PE, like by far. If you compare it, like say to Google, which is a growth stock, it's triple Google's PE almost. So let's put 91 times Tesla's earnings and see what that gives us. Well, at 91 times Tesla's current earnings, which is forecasting phenomenal growth, 91 times is phenomenal growth. They're forecasting a price of Tesla at $45.50. Okay, now Tesla's PE right now is 1,637. 1,637. That puts it here. Now let's take Tesla's PE ratio and multiply it by Google, who has the highest earnings per share in the top 10 of the S&P 500 by cap. It would put Tesla's price, if Tesla was earning $51.75 per share, it'll get there. That's at 105 times their current earnings, okay? 51.75, that puts the stock at almost $85,000 a share. Now, let's take a fictional stock that is great by anybody's measure with Google's earnings and Amazon's PE, which is still too high, but let's assume this company is still forecast to grow like gangbusters. That puts that PE, 91 times 51.75, puts a share value of $4,709 a share. Tesla's earnings, 103 times, puts Tesla at $85,500 a share. Can you guys see the relationship and how out of whack this number is with that number or that number? This is where it should be trading at a really high PE. Okay, that's at a really high PE. At the current, that's where it would be. You would see growth, but I would expect this to grow to $200 or something as their earnings grow. So that's the extreme. I think, one way to trade Tesla, like as a long-term, if you want to trade it and you have the skill, the stock is volatile, does amazing things, you could probably make a lot of money trading it if you have the skill, okay? But as a long-term investment, are you paying too much? $45 versus $826 Friday's close. I think if you see, do I think Tesla's earnings could get to Google's level of $51.75 a share? Yes. I think their growth potential is phenomenal. Is it going to take some time? Yes, it'll take 5-10 years. Okay? In 5-10 years, we're almost guaranteed to have another significant market correction, be it a political thing or war or, fat finger mistake by a hedge fund or somebody. That'll push this. Anyways, you'll buy Tesla. All these stocks will get slammed at some point in a market correction like we just saw in March, where everything, good stocks, bad stocks, they all got flushed in the toilet, at least temporarily. It happened in 2008. It happened in 2000. It happened in 1987. Some other small ones in between. There were chances to buy all these stocks at phenomenal prices. This will happen again. It's just the way the market works. How to approach it? Where do you want to be? Decide where you want to. Let's say you're twice as bullish as me about this price. Put a bid at, say, $100 if you love this stock, and put it in as a GTC, a good till cancel order. You can leave this in with your broker, your trading platform, and you can put an order to buy it at a fixed price and leave it in indefinitely. Some brokerage firms, platforms will force you to put a time limit like 30 days or 6 months or something, but you can just renew that every time, and you can increase it as earnings growth. If you still excuse me, forecast 91 times and you're 45 bid there, you can, if this goes to $1, you're obviously going to double this, and so on. So that's my discussion of PE and how outlandish I find the price of Tesla is right now. Be really careful. Take some money off the table. If you're a long-term investor, invested in a portfolio of other growth stocks, it could be these, it could be whatever you choose, maybe just an ETF of the S&P 500 like the SPY. But while you're waiting for it to go, Tesla is going to fall apart at some point. If you listen to me today and sell the stock and it goes to 1,200, you might be angry at me. It might hit 2,000, God knows. But at some point, it's going to be closer to this in relation to its PE ratio. And you're not going to be disappointed if you sold some now and invested it in other places that had a less insane PE ratio. So don't think about the price of the stock, guys. Think about the PE ratio. How much are you willing to pay for those future dollars of earnings? And for a discussion on bubbles, please read Extraordinary Popular Delusions of Madness of Crowds. It's a book written in 1841 by Charles Mackey. It's a discussion of the historical bubbles that had happened up to that point, and published over 160 years ago. It is 107 years ago. It's absolutely as relevant today as it was back then. People haven't changed. We get caught up. We do. It's going to happen again. Real estate bubbles, tech stock bubbles, Tesla bubbles, gold bubbles, Beanie Babies, and Cabbage Patch Kids. It all ends the same way. So don't get caught in it, and good luck with your investing.